It's changed a lot and changed very little. Let's deal with the little. People want performance, and they will flock to what they perceive is good performance. The main differences are in two areas. First, distribution, and second, in transacting. In terms of distribution, at one point, most of the funds were sold by large brokers in the US and large banks on the continent and independent advisors in the UK. In terms of transacting, there were a limited number of places to transact on various stock exchanges or organized over-the-counter markets. Now, I don't know that anybody knows the exact number of all the places one could transact, and certainly globally, but also, well, within major markets. The next point is, it used to be that people invested for the long term. There were fund groups in the US that had a shareholder base that turned over their money every 18 years. Then it was 8 years. Now on average it's 3, and in some groups it may be 3 months. Major difference. Bonds were dull and not very interesting. Now the bond market, which was always bigger than the stock market, but is a major competitor for assets, not in terms of performance, but in terms of perceived safety. We've had 2 additional increments, the first being money market funds, which was a bank replacement vehicle in many respects, and the second is tax exempt in a fund format. They already existed, but because of some tax regulations, it was difficult to organize them in a fund. Clearly, on top of all this, we've had an enormous growth of what we can label derivatives, but it's all kinds of different instruments that didn't exist before.